Hey everyone, welcome back to Corporate Decoder, the place where we decode the hidden messages in corporate filings. Today we're digging into Capstone Holding Corp's latest report, and let's just say things got a little adjusted. So, what exactly is this document all about? It is a Form 8K, which is like a special announcement for companies, telling investors about big events that are happening right now. Think of it as a news flash from the corporate world. This particular flash is from Capstone Holding Corp. They're letting us know about some important changes to a financial deal they made. Now, Capstone shares are traded on the Nasdaq, which is a pretty big deal, and they're telling us they are what is called an emerging growth company. This basically means they are a younger company that gets some special treatment under the rules, like a bit more time to get certain financial things in order. The main story here revolves around some notes the company issued earlier. Back in July, they made a deal with an investor to sell them convertible notes. Think of these notes like loans, but with a special feature they can be turned into company stock. The total amount they could potentially borrow was quite large, almost $11 million. They issued the first note in July and another one in October. Now, these notes had a conversion price. This is the price at which the investor could turn their loan into shares. For the note issued in July, the initial price was $1.72, but it was later lowered to $1. The October note started with a conversion price of $1.1. Here is where it gets interesting. On the 28th of November, the company and the investor agreed to change that conversion price again. Why? Usually this happens when the company's stock price has dropped. If the stock price falls below the conversion price, the investor might not be keen on converting their loan into stock because they would end up paying more for the stock than it is currently worth on the market. To keep the deal attractive, the company might agree to lower the conversion price. So the company agreed to a significantly lower conversion price of $0.75 for the remaining balance of the July note, which was about $500,000. This shows the investor wasn't getting as much value as expected from the initial terms. They also adjusted the price for a big chunk of the October note, lowering it to $0.75. However, a portion of the October note, about $1.77 million, still keeps its original $1.1 conversion price. This is a bit of a mixed bag, suggesting some parts of the deal are more distressed than others. The actual document detailing this change is called a Conversion Price Voluntary Adjustment Notice. It is the formal paperwork making these new terms official. And as most filings do, they've included the standard interactive data file, which is useful for machines to read, but not so much for our storytelling here. Finally, the report is signed by Matthew E. Lipman, the Chief Executive Officer. This is common practice, showing the company leadership is aware and approving of this filing. Now, let's put on our Warren Buffett hat and see what this really means. On the surface, this filing tells us about adjustments to a debt agreement. But what's the story beneath the surface? Capstone Holding Corp issued convertible notes, essentially borrowing money that could become stock. The fact that they had to repeatedly lower the conversion price, especially to $0.75, signals that the company's stock price has likely fallen considerably below what was initially anticipated when these agreements were made. This isn't necessarily a death knell, but it's a clear indicator that the market is not valuing Capstone's stock as highly as the company, or its investors might have hoped. The investor taking on these notes might be getting a better deal on their conversion into stock, which dilutes the ownership of existing shareholders. So, while the company gets much needed capital, existing shareholders will own a smaller piece of the pie going forward if these notes are converted. The mixed adjustment on the October note is also noteworthy. It suggests a complex negotiation where some debt is considered more at risk than others. The company might be trying to preserve some upside for the investor on a portion of the debt. Or perhaps there are different conditions attached to that specific part of the loan. Looking ahead, the key risk here is the company's ability to turn things around. If the stock price doesn't recover, more of these notes might be converted at these lowered prices, putting further downward pressure on the stock and diluting existing shareholders. On the other hand, if Capstone can improve its financial performance and market perception, these adjustments might simply be a necessary hurdle to overcome in securing funding for growth. The opportunity would be if this financing combined with these adjusted terms allows the company to execute a successful strategy that eventually drives the stock price higher, making the conversion a win for both the investor and the company in the long run. But right now, the signal is one of caution and a need for Capstone to demonstrate tangible progress. Alright, that is our breakdown of Capstone Holding Corp's latest filing. What is your take on these numbers and what they signal for the company's future? Do you think this adjustment is a sign of trouble or a smart move to secure financing? Drop your thoughts in the comments if this analysis was valuable. Hitting that like button really helps. And subscribe for more deep dives into corporate secrets. Don't forget to check out the Discord in the description for even more insights and discussions. Thanks for watching. See you next time.